So, depreciation in accounting sense is just an estimate. We recognize that the asset may get obsolete. We also recognize that the asset may be losing production capacity and production ability, and based on that, we make some estimate and reallocate the value of the asset into costs, and nothing more than that. We do not create any cash fund or any cash reserve. The fact that we depreciated the asset does not mean that we have money to buy the new asset to replace the depreciated asset. Whereas in economics, it's different. In economics, we try to get the true picture of the loss of production ability. So it is not an estimate, it's a more systematic analysis of the loss of value of assets. And secondly, in economics, we may create special funds for replacement of assets. And therefore, if you remember the income method of estimation of GDP, depreciation is included as a special category of income. Why? Because depreciation leads us to creation of special replacement fund that will give us income in the future once we replace the assets. But in accounting sense, there is no cash fund. And another feature here is that if the company is bankrupt, is going to be bankrupt, is not a going concern entity, then of course you do not need to depreciate the asset. In this case, the assets would be stated at their fair value. And also with the buildings and equipment, it's pretty clear they are losing the value over time. But if you look at land improvements also lose their value over time. Land improvements are some structural additions to the land. It's not land itself, but various parking lots, fences, landscaping, sprinklers, driveways, and of course over time they get old, so you need to replace them. So therefore you will perform depreciation on land improvements. And to repeat, on land you do not perform any depreciation. Regarding so you need to know the useful life, the historical cost, and the residual value. Sometimes the residual value may be zero, then you just ignore it. It is important that you perform the depreciation and the last figure in your estimate must be equal to the residual value. You must not over-depreciate and you must not under-depreciate, because if you over-depreciate the asset, then obviously your expenses, depreciation expenses would be higher and the profit would be lower than it should be. And in contrast, if you under-depreciate the asset, then your expenses, depreciation expenses would be smaller than they should be and profit would be overestimated. So we have equipment, $13,000 cost, expected residual value 1,000, 5-year useful life, and well, the useful life in miles, we'll use it in the third method. So first of all, you need to find, let's look at the straight line method of depreciation. So you have cost minus residual value, you get depreciable cost. If it's a straight line method of depreciation, then in every year you will have same depreciation expense. Just divide 12,000 by 5, so it's 2,400. So $12,000. The annual depreciation expense is 2,400 every year. You can find accumulated depreciation. Obviously, in the second year it would be 4,800. In the third year it's 4,800 plus 2,000, 7,200. And then the book value. The book value you must subtract not from depreciable cost, but from historical cost. From 13,000 you subtract 2,400 and you will get book value at the end of the year 10,600. After that you subtract from 10,600 you will subtract 2,400 and you will get 8,200. From 8,200 you subtract 2,400, you get 5,800, and so on until you reach 1,000. Don't go below 1,000. Don't get the last figure above 1,000, because in this case below 1,000 it's over depreciation. If it is say 1,200, it's under depreciation. They are not allowed.